Hello, everyone, and welcome to the Taxable Portfolio 2024 Income Estimate Review. In this video, what I'm going to do is I'm going to walk everyone through how I do my estimates for future income in terms of what is a portfolio going to generate. I look at some of the previous history in terms of the increases that have been previously seen, and how that might factor into future ones, but also looking at pulling out individual factors. In this case, you'll see that I've pulled out CD income and money market income and how I treat those a little bit differently when coming up with what the estimates are going to be for 2024. So without further ado, let's jump into some of the numbers. But before I get there, so I'll always err on the side of safety. What you're going to see here is I'm going to start with the low end of estimates, which is kind of like the least optimistic scenario. We're going to say, what if there was no dividend increases? What if we earned zero money off of money market and certificates of deposit? Basically, the worst possible baseline that I can think of, other than dividend decreases. I typically don't do anything related to dividend decreases unless there's a company that's actually held in the portfolio that I'm concerned about. But if there is no companies that I'm necessarily concerned about, then I'm not going to explore that route. And then I think I'd already mentioned that, but the initial estimates look a little bit bleak. And the main reason for that is the fact that we are pulling out certificates of deposit in Charles Schwab money market. And the big reason why we do that is they're just a little bit harder to track. And so I wanted to isolate it, because the other thing too is that you don't want to apply, when you're doing your dividend increase estimates, you don't want to say these funds that are invested in a fixed income investment, and I treat money markets like that, even though I know it's variable rate. But you don't want to include those dollar amounts in the increases, because you can't say a CD that's fixed at 5% for a year is going to somehow increase the dividends that it's paying out, or increase the interest that it's paying out. So the first screenshot here in terms of the table is, so 2023 highlighted in green, that is the income that was actually produced by the portfolio. So in this case, you can see it was just under $1,900 a month of income that this portfolio generated. And the idea here is that that is income that is always collected as cash. And so John and Jane could have hypothetically drawn out $1,893.01, and that would have helped them remain cash flow neutral at least. They've been drawing out $1,700, so this has actually still been cash flow positive, even though they've been drawing out a pretty substantial amount. Now, 2024 highlighted in yellow. The thing about these numbers is that this is going to be where I go through once a year and I update all of my fields from January through December, and I say, okay, if we kept the same number of stocks as we stock count as we currently have for each of these companies, what would be the dividends paid out? The other thing I do with this too is it allows me to go in and remove special dividends that have been earned, so that when we're doing these projections, we're saying, what if the snapshot we have on January 1st, what if that is the same exact portfolio composition that we have for all of 2024? And that's essentially where these estimates come from. Now, as I mentioned on the previous slide, we're talking about potentially an 8% loss, but in this is not in these numbers do not include what is going to potentially be earned by certificates of deposit and money market. With those numbers, I ended up using 4% as the baseline. Right now, you can get between about 4.75 to the low 5% range for CDs. So the thing is that you could have added these in here. It can be difficult, depends on whether it's a CD that pays out monthly, whether it pays at maturity, whether the expiration date happens partway through the year. And so I just don't like having to mess with those factors necessarily, and so that's part of the reason why I remove it and come up with this kind of worst case scenario. Now, I can use the previous dividend increase history, and what you can see here is that the portfolio has grown on average its income generated by 10.66% annually, and that's simple math, just using the starting point of what we had in 2008 up to what we know we've received through 2023, and then averaged it out through the years here. Now, one of the things that I do want to point out, and I've mentioned this in other videos, is that this first increase from 2018 to 2019 is not going to be 100% accurate. And the reason for that is that in 2018 there was a lot more cash still sitting on the sidelines than there was in 2019. It wasn't like we just saw September's income, for example, increase by $1,000 out of nowhere when you're looking at these numbers. It's that, okay, well, maybe there were stocks that weren't owned during that time. So there's a little bit of that involved in here. But I still think, a 10% growth to me is pretty substantial. So even though we've seen some above average years like here in 2021, this is definitely going to be on the high end of what I would think the expectations are going to be. So, and just go back to that previous slide, that 10.66%. Really what I'm mostly saying with that is that if my initial estimates came out to be where I was making more than 10.66%, it might actually make me a little bit concerned that I'm being a little bit too generous with my numbers. So I kind of use that as my benchmark to be able to say, okay, does this seem reasonable in comparison to what our historical results have provided us with? So on this table, on this screen here, again, 2023 income highlighted in green. The next column over where it says 2024 X CDs, that is using the same income estimates that you saw on the previous screen. It's just a reminder that this does not include any certificate or money market income in those numbers. Now, the next column over, 2024 with CDs, what I did here is I said, what if all of the cash holdings and all those certificates and money market, what if all of that was invested at about 4%? And I'm using that as my number because, again, I think you can easily find something 4%. Even if the Fed decreases rates, I think 4% is still pretty reasonable. But basically, in their portfolio, it'd be generating about $190 a month of interest income from those sources. So if we totaled all of this up and then added it to the previous column, that's where I get the $23,188.94 from. And so really what this column is telling us is it's saying, let's assume that no companies raise their dividend at all, and everything on the dividend side stayed very stagnant. But we were able to get 4% on all of the cash that we have on hand in terms of money market and CDs. And so we would be looking at a 2.1% growth year over year as compared to what was a negative 8% growth. The relevance here is that substantial switch here tells us how much more reliant the taxable portfolio has become on those kind of fixed income instruments like that. Because in this case, otherwise it would just be cash sitting on the sideline, or I'd have to have it invested in other dividend paying stocks. But for anyone who's been watching the videos, you know that my goal lately has been to de-risk the portfolio. So now that we have this 2.1% baseline where we say, okay, we've accounted for the certificate income, money market income, and then also all the income that we expect to see if there was no increases, now is where we apply the 3%, 5%, or 7% increases in order to kind of see what a low and high range is going to look like. With the 3% here, and I think another thing that's worth pointing out is that I've taken this here and I've isolated this, and the biggest reason for doing that is because now I'm not saying that this potential money is subject to a 3% increase, because as everyone knows, if you're invested at 4% in a certificate of deposit, there is no increases that are going to come from that. I don't think I've even seen it before, like a variable rate CD. I've seen CDs that have bumps, but the brokered CDs that John and Jane use, That's not something where there's going to be bumps involved, and usually they're very short term. So with the 3% increase, we're solely applying this increase to the income that's being generated by stocks, because those are the ones that are actually eligible for having the dividend increased, because that's the primary reason why we bought those specific stocks. So 5% is just 5% here, plus the amount earned in certificates and money market, and then again for 7% as well. So you can see that when we factor these in, the range now goes from about 4.8% to 8.5%, and that is saying in the least optimistic dividend growth scenario, now we're talking about realistically just under 5% growth. But in the most optimistic scenario here, or at least what would be an awesome return, would end up being 8.5%, and that is in line with that 10.66% number. But as I mentioned, I think that 10.66% runs a little bit high because of that first year in particular. So 8.5% to me seems very reasonable in comparison. So on the conclusion here, the income has grown and varied between mid-single digit growth and then high double figure growth over the last 6 years. So more likely the middle to upper single digit growth is the thing that seems the most plausible to me. So when we factor that in and we say, okay, well, since the 3% to 5% scenario is more likely due to rougher economic conditions, more companies focused on paying down debt because of the cost of the debt, rather than providing dividend increases to the shareholders. We're projecting income to increase somewhere between about 4.8% to 6.7%. Now, these numbers might increase substantially if we're able to invest most of the extra money at, say, 5% instead of 4% with regard to the CDs and money markets. But like I've mentioned before, my goal is to always err on the side of safety. So there's, I think there's two big factors that could change the outcome of these scenarios here. And these are things that are really difficult to project. And so the first one is kind of a two-part thing. If, say, for instance, we were to sell shares that have a lower yield in favor of shares or investments that have a higher yield, that could have a pretty big impact on the portfolio. But also the opposite is true. If we sold, higher yield investments, especially because those are going to be the ones that present more risk, in favor of lower yield investments, that could also have a negative impact going the other direction with it. And then the last thing, and everyone that watches these is probably aware of this, but basically depends on what the Federal Reserve is going to do. If they raise rates, if they lower rates, I'd be surprised if they made too substantial of a decrease in the rates. But I think we are probably looking at a little bit, higher rates for longer. So anyway, but hopefully everyone found this helpful. Let me know if you have any questions in the comments. If there's anything that didn't make sense you'd like me to elaborate on, more than happy to do it. But I appreciate everyone taking the time to watch. And I'm going to be making the same exact videos for John and Jane's retirement accounts. And I look forward to also hitting the end of the month for January and being able to make the first videos for 2024 income that's been collected. So again, let me know if you have any questions. Thanks, everyone.